All right. Good morning, everybody. This is a really big week. This is the biggest week in the quarter. There's nothing else coming down the road between now and May that has the impact of this week. So kind of carry that with you this week when you're thinking about new positions. I'm not sure that you really want to be opening new swings on a week like this. Maybe wait until, we get onto the other side of it at least. So looking at what's going on around the world, the U.S. markets are basically flat, just kind of holding. And I would not be surprised if we see some violence in the first part of the week because we're going to get some QRA data today around, it's in the afternoon. I think it's 3 o'clock or 2 o'clock. So we're going to get that 3 o'clock. Okay, I just checked. But for the bigger picture for this FOMC week, I think it's hurry up and wait, right? That you're going to want to sell into strength, buy into weakness, expect a range that maybe continues to widen out like a megaphone pattern until at least Wednesday. On Wednesday, we'll get the rest of the QRA data early in the morning, and then we'll have POW and FOMC in the afternoon, and that'll be most of it. Then we have non-farm payrolls on Friday, and that'll finish it off. There was a time where we always knew we were going to be range bound into FOMC. And then we started to get those weeks on FOMC when the market, instead of being range bound, actually ran. And there's many examples where, we had a FOMC week where we reached the edge of the weekly expected move before Wednesday. So don't assume that we're not going anywhere. That's the baseline bet, is that we're going to wait for data. But because of the big tech names that are reporting earnings this week and because of the QRA this week, I don't necessarily believe that we're going to wait quietly for FOMC. That's what we have this morning. The U.S. markets are basically flat. There was news Europe last week, right? And they basically said they didn't see any cuts until the later part of the year. But on finance juice, they were already starting to price in 25 basis points for April. So now maybe need to circle back and take a closer look at what's going on. Maybe. So I know it says nothing is scheduled today, but we have the first part of the QRA data coming out today. It's a really big deal. It's going to hit at 3 o'clock. Now, this page is generally reserved for the big stuff. They don't want to look like, FX Street with 40 things on the agenda. They only want to highlight the biggest things. So it's not a surprise that it says nothing scheduled. But you're not going to see that QRA on something like Finance Juice or FX Street. It's nuanced enough that there's just nothing, there's nobody talking about it. Maybe some quant nerds somewhere are out chipping teeth on it. But that's about it. We do have additional auctions today. They're both in the front end, 3 and 6 month. You could probably look at IRX, kind of see its impact. And we are going to get, or we already did get, some ECB and Bank of England speakers, which might help clarify this statement a little better. I shared the put and call scan last week. We kept seeing the indexes on there, which was handy, right? When we'd see the Dow SPY right now is at, well, not now, but when it went into the close last week was at its put support. So it's always worth taking a look at those just to see if there's a market on there that you trade, maybe that you're in. The SPX is at its call resistance when it went into the close on Friday. Ten 10:30, 11:30, and then 3 o'clock. I know it's not listed here, but 3 o'clock today. You know, it's power hour anyways. You're probably already watching the clock at 3 o'clock. Just today, you got an extra reason to be cautious, right? So you can see the gamma levels. We're a long ways from the 49.76 call wall. We are quite a distance from the put wall. It's down there somewhere. We don't have an MDP because we've crossed through it. We started out the week right at the weekly pivot point, which I like that. We're not, you know, overbought or overextended. We haven't moved too far already. And because of the pullback and kind of the consolidation that we had last week, it gave us time to get caught up with that weekly pivot point. Now, you know, I'm of two minds of this, really. I mean, look how we started last week, so far away from the weekly pivot, and we held it, but we didn't really advance that much more beyond it. And so this week, the math brought the weekly pivot right to us. That makes it a lot easier to get underneath it. So just kind of keep that in mind. The channel around my daily pivot point is really narrow. Generally speaking, when we open underneath the daily pivot point, that puts us in a bearish posture, but the fact that we've rallied through it kind of says that we can keep it. We're holding relatively close to the VWAP. So right now we have a reciprocation. Want to continue to watch this until we don't have it anymore. What we got on this side was the same as what we got on that side. So now we've got this measure. If we do come down, then we'll get the same on the other side, right? It's reciprocation. Want to continue to watch that until it breaks, because right now that's just a signal of balance. It's a little sloppy, but it's still balance. Until that balance breaks, then there's not really an expectation we're going to expand too far beyond the VWAP. Once it does break, however, you get something like this with a generous move away from VWAP. Of course, you still get reciprocation eventually. We're closer to the ADR high than we are the ADR low, which implies that's where the market wants to go first. It doesn't owe us more than that. Still going to focus on the ADR high and the ADR low as our targets for today. It's not honestly either or, it's yes, both. The sooner we hit one, the sooner we can hit the other. The sooner we hit one, the more likely it is we'll hit the other. Because of the FOMC week, a lot of traders take this week off. And I know that's not a popular thing to say. Nobody learned how to trade just to take time off and don't trade. But if there ever was a time to call timeout, it would be during the FOMC week. We've seen last week how the market started to tighten up in preparation for this monumental week. We could just do more of the same for the rest of the week. That we could have more of this, which, you know, don't get me wrong, there's plenty of movement in here. But if you struggled last week, that's what you're going to get again this week. one of the things that you could focus on is just getting outside of this range and then trying to trade. Right? So break out above the previous week's high, which also happens to be Friday's high, and or break down below Friday's low would be a good start, right? If we're in our own Globex, you're generally going to have a harder time trading. And then if we are in yesterday's price, you're generally going to have a harder time trading. So if you're losing more often than you win, quit doing the hard stuff. Do the easy stuff. The volume's not too light, but it's pretty close. If it was just a little bit lower, we would be concerned about how light the volume is. The only difference is when we come in, the reason I built this indicator is the first thing I do when I turn on my machines in the morning is I check this overnight liquidity. I look to see, what did we do overnight? And that number gets me in a hurry to go look at the news, or I take my time to go look at the news, if it's too light or not. Either way, I'm going to get to the news, just how fast. So if it was too light, we'd really want to get back over to the news and start looking around and trying to understand, why is this so light? Now, on a week like this, we already know why it's light. So this isn't going to be much use today. We don't really have any significant voodoo lines near us, so we don't really need to lay those out. And we still have the 10-day moving averages, but we're going to get to those anyways. Ten-day, 30-minute volume profile. The point of control is where we are, and that's not much of a surprise. We knew that we were losing the point of control along the lows and talked about it last week. Hey, look, we're there. If we happen to break 48.80, then we're very likely going to move through this zone. So we break that, we'll drop down to there relatively quick. It's a cog line 48.11. It's the point of control for the TPO. You can see that the TPO is still relatively shallow up here where we're at, which just shows that as we ran up into this level, we hit a significant amount of volume, but we haven't spent a significant amount of time there. That's why we stack those two beside each other, right? Put volume profile with TPO. You could call it an air pocket of risk, but it's not a very large pocket. Honestly, we're looking at like 50 points, 40 points. It's not that bad, but yeah, you could. I don't know. Just keep in mind what I've mentioned before, that we've made our support now at this level, but when we first got up there and we were bouncing, we weren't bouncing on anything. There was nothing there to bounce on. So why did price hold right there? Well, I argue that the S&P didn't find support there, that an inverse or a correlated market somewhere else hit support or hit resistance, and when it moved, the S&P moved and it held the line. And now that we've built our own structure there, should price come back down into that area, we could find support just from what we already made for ourselves. But I would still say that it's likely tied to the 10-year, the Dixie, something, right? No VPOC again today, but we are surrounded by them. We've got plenty, especially for any downside moves. We have a little bit of a disagreement between the TPO and the volume profile this morning as well, showing that we ran up into some significant volume here at the highs and that we have not spent a significant period of time at these highs. It's exactly what the bigger profile was showing on a 10-day time frame. It really looks like they defended the Globex high today. If you think about where we were for the kill zone, right? We just did a whole big roundabout loop-de-loop and just right back where we started. I really like the idea of selling into strength and buying into weakness. But the thing is, when you've had price in a range and it's just been doing its thing, working out really well, and then it starts to break out. Why? Because the liquidity resides on the other side of the pivot. So it gets a little bit higher, a little bit lower, and a little bit higher, and a little bit lower, until finally something breaks and we get that breakout. Well, we've been in this game already, this sideways play, long enough now that even on Friday, we got just a little bit higher than we did Wednesday. Sell into strength, buy into weakness, and we'll run that range, run the range until finally the range breaks. Last week's weekly expected move held, which is pretty awesome. This was the weekly expected move for last week. We broke outside of it a few times, but we did close inside the box. So one of the things that I like to do on Monday is just copy that box and put it on the new week and ask, how's the volatility for this week? Did it increase or did it decrease? And the reason we're asking about volatility is the distance that this box shows how big the box is. It comes from the measurements of volatility. So if the volatility was low, the box would be smaller. If the volatility is greater, the box would be bigger. This week's volatility looks to be the same as last week's volatility. So a controversial phrase, the first time I heard it, I thought, well, that's stupid. That don't make any sense. Volatility and FOMC. FOMC is a volatility suppressor. I completely disagreed with that the first time I ever heard the sentence. FOMC is a volatility suppressor. Now, if you're just thinking about when Powell chips teeth on the podium and the market explodes, then you're doing what I did the first time I heard that. But think about how the market acts as we approach FOMC. We start to go range bound. We start selling into strength, buying into weakness. We start holding the levels and holding the lines. Of volatility is a nerd word for movement. So if we're not moving, volatility is decreasing. FOMC is a volatility suppressor all the way up until the event. And then, oh boy, here comes the volatility. So it kind of makes sense that this week has the same level of volatility as last week, since we're waiting on FOMC. But on the other side of that, once we do get the data, well, then we're kind of expecting the volatility to come in. Last October 31st, November 1st, we got the QRA of Q4. And all of this has been the result of that QRA. Back in July and August 1st of last year, we got the QRA, Q3, and all of that entire move was what came with it. So the highest point on the year to that point of the year, all the way down to these 4,200 levels. It's a 500 point drop in one quarter. And then from 4,200 all the way up to 48 and a half. These are magnificent moves, right? So when we talk this week about QRA and FOMC, think about how far the market can go in a quarter, because that's really what's on the table. What's going to happen for the next quarter? And don't get me wrong, Apple, Microsoft, Google, Amazon, all of those have to come into the equation. What the Fed actually has to say, that's going to come into it too. There's a lot more than just QRA. We're not yet 1% above the 10-day moving average, so we're not overbought. We are working our way back down to it, whether that's because price is going down to the 10 or because price is holding sideways and the 10 is coming up to us. Either way, we're moving closer to the 10. It's hard to see in the background, but this blue line has started to flatten out. So I want to be aware of that too. That's the average distance from 10, right? We're looking at the real distance from 10 with this histogram bar, but that blue one, it's taking an average, like a moving average, and it's asking what's the average distance from 10 before we flip. Oddly enough, right now, the average is low enough that it's about 0.5%. And we're beyond that. So that does give us a little bit of a concern. The thing is, moving averages lag. So we can see how we've been overshooting that 0.5%. We've been overshooting that blue line considerably. And because of it, the blue line is going to start to move up, but it hasn't yet. So that kind of gives you an idea of how much of a lag there is. The one I tend to look at more is the distance from the 10-week, which is right now around 3%. Now, sure, we've been farther away than that. So, it's not like the end of the world, but we're on our way back towards the 10 here too. So it's something to be, aware of. But the blue line is on its way up. So I like to think of that blue line as volatility. Remember, volatility is the nerd word for movement. How far we could move on a day-to-day basis, how far we could get from the 10 without being considered overbought or oversold. When that distance is increasing, volatility is increasing, or is expected to increase. You say it that way. The weekly has a habit of just dropping from these high levels all the way down without trending down to it, just dropping down. It happens more often than I like. So something to keep in mind as well, that we can get back to that 10 on the 10-week really fast. All right, so I got Apple here on the daily. We're down just slightly on the bid ask, so we're not outside this candle's range yet, but we are a little bit soft. There's quite a number of gaps that need to be filled. If we continue this move to the downside in Apple, one gap that needs filled is 191.56. Kind of wouldn't surprise me if we get all the way down there and then start trying to work our way back up, get a little bit of a gap fill and then a bounce on support. 193.35 is the half back. UNG is down the most this morning. It's about the only thing. Went into the close at 2014. It's at 1965 this morning. So still within inside yesterday's range, but not by much. We didn't really have a double bottom on this, even a micro one. Remember, double bottoms are supposed to go lower than the previous low. Well, this really didn't do that. So it was more like a cup and handle and less like a double bottom. And remember, a cup and handle, or an inverted cup and handle in this case, would bounce equally, pull back about 1/3, and then continue that drive to the downside. A double bottom, on the other hand, would have overshot and then trap the bears and spring back up. This is a gappy booger though, so I would approach with a little bit of caution. Plus, it's like, how much lower do we think this thing can get? It's been beat down and beat down, but I would not be surprised if we revisit that 18 level. To the penny, no less. Gold and gold miners are up, so are the fangs. Semiconductors are almost up enough for us to be able to look at, but really that's what we got. And it's not much of a surprise. I wasn't overly enthusiastic about what we would find this morning. I think a lot of the market this week is going to be that way. Kind of a hurry up and wait. So we got semiconductors here. A little bit of a gap up this morning. Wouldn't surprise, if we come back down and get that gap closed and then start asking the question, what next? If we keep it, then we want to focus on the halfback, 191.75 for the semiconductors. And that's if we can get through all of this selling up here. So without using the homemade ETF, we can look at how the NY Fang closed last week. It looks a lot like that semiconductor chart we were just looking at, right? Which kind of makes sense. The NY Fang isn't open in the pre-market, so we can't gauge where it's at from that. But here is a pre-market on the NY Fang. And we can see we're red to green. All right, so I'm on a daily. We see all this selling pressure across the top. Every time we tried to get up into that new high, that sold off again. The white line is the closest moving average. And even in the sell-offs, we've been keeping back above it by the close. If we're going to get a short in broader tech or the Magnificent Seven, we want to see the NY Fang, whether it's this one or the ICE ETF or index. It's got to break that moving average. 3-day moving average, you can use the 4, doesn't really matter, 3 or 4. That would just be the good start, right? If we're going to get a surge, a downside surge, then we need price to cut the 3 and then the 10 and then 3 to cut the 10. It's 3 pieces of the surge, right? 1 and 2 and then 3. Otherwise, when we crossed up through it, which kind of had the run back here. So there was our pullback. There was our hold. Breakthrough 10 and 20. And then the 3 through the 10. A little bit of a pullback. But the MA's never crossed back under. And a continuation. So until something changes, this still says bullish. And that's what has to change. One of the things that'll help it do that is if it keeps correcting in time, keeps going sideways here, long enough for this 10 to get up here, then price can jump the 10 and the MA can drop right down below it too, just like we did back here. The 10 was still a considerable distance away. It got closer, price jumped them both, and the MA followed right behind it really quick. Same thing back here. The 10 was a long ways off. We went sideways, let the 10 catch up, broke through it. Makes sense? So we're a little early if we're thinking about a downside shot. They've tried that a few times already. The 10 was too far away. We didn't get it yet. Nat gas, solar, airlines, those are all down this morning. Crude through USO. Solar was tied with the China ADRs or linked to it. Let's say it that way. We've seen the China ADRs popping to the upside last week. We heard the discussion about China with stimulus, and that fueled a little bit of a move in solar, as well as the EVs, since they are tangentially connected. But if any of that is coming into question, especially with Evergrande back in the news this morning with liquidation, that's a saga that has lasted for a few years now, and it's still not done. But it kind of makes sense why there's weakness in the China ADRs and in that whole space. They kind of got their hands full with Evergrande. But that doesn't mean we're quite done with those China ADRs, and I wouldn't be surprised if we see more out of Baba, Baidu, all of those. And precious metals tends to run into an FOMC event. I don't have any proof of that. I'm honestly repeating what I've heard from someone much smarter than me say repeatedly over and over. Every FOMC over the last few years, I've heard this statement. I've never checked it for myself, but if someone cares to do the legwork, let me know what you find. I have found tangentially, watching it, keeping my eye on it, that it tends to be true. But by how much? I don't know. But we're seeing it again. We're getting into FOMC, and we've got silver and gold on the move to the upside. Bonds up. But what we need for the S&P to get through that resistance, for us to swap from selling strength into buying strength, we need the Magnificent Seven, semiconductors, communications, technology. We need those, right? And if we don't get it, we're not gonna continue to, sell into strength, which is the base case argument for right now. Play the range and watch the clock. There's a lot of data points coming out. One of them today that I'm going to just keep repeating because it's not on any docket anywhere that we've looked at is 3 o'clock today. The first QRA announcement is at 3 o'clock. That's going to give the total amount of issuance. The more important one will be Wednesday morning at 8:30, which will give the composition of the issuance between bills and bonds. But make no mistake about it, today at 3, that matters. Okay. That's what I got for you guys. Be careful, be safe, watch the clock. I'll see y'all tomorrow.